This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, I'm hoping that this is going to be one of the easiest and quickest chapters for us to get through, given that everything that we do in this chapter we have already seen. All the techniques and rules that apply to rollover relief, where we deal with a qualifying business asset being sold and another qualifying business asset acquired, all of the techniques and rules for rollover remain exactly the same as we saw in Chapter 14 when dealing with individuals and charging any remaining chargeable gain post-rollover to tax, only this time it's corporate tax within the corporate tax computation rather than CGT, as it was when an unincorporated trader was doing the selling and the buying. So all those rules are the same. The only thing that is different from Chapter 12 is, of course, what we learnt in Chapter 19, and we've said so many times before over the last few chapters, and that is that in computing the bottom line chargeable gain for a company, we get to deduct indexation allowance. If, of course, that asset was acquired before December 2017, then indexation allowance would be available from the date acquired through to December 17. The indexation factor you need will be given to you in the examination question. They may, of course, give you more than just the indexation factor that you need, again, giving you as forever the sufficient rope by which to hang yourself there. We know by now which indexation factor to pick up. And all we've got to do is apply that to the allowable cost to give us our chargeable gain. It is then that gain that may be eligible for rollover, and the rollover depends on, as well we know, and we'll see in the rules that we'll go through yet again in a moment's time, have we managed to reinvest all the sale proceeds in another qualifying business asset within the specified time period allowed that ran from a year before, 12 months before the disposal date, to 3 years after the disposal date. If we have in that time period, that 4-year window of opportunity for the reinvestment to occur, if we've reinvested all the proceeds in that time period, then the entire gain on the disposal that we are dealing with, the entire gain will be able to be deferred through a rollover claim. What does rollover relief do? Well, we've said the half of it there, it defers the gain. How does it defer the gain? By reducing, of course, the base cost of the newly acquired qualifying business asset. By reducing that cost when it is subsequently sold at some future point in time, if it's got a lower cost, then the chargeable gain is going to be that much bigger as a result. If, of course, we fail to reinvest all of the proceeds within that 4-year period, from a year before to 3 years after disposal date, then some of that gain will remain chargeable. To the extent that we fail to reinvest any of the proceeds, that amount of the gain will remain chargeable, and only the balance will be eligible for rollover. The other situation we look at in this chapter, still a part of exactly what we've done before, back in Chapter 14, is if the asset that we replace the old one with, that we buy, if that asset bought, the object of the rollover deduction, if that asset turns out to be a depreciating asset, I hope that means something to you. If not, check it out. If it's a depreciating asset, then although a deferral will be possible, it will not be through rollover relief. We do not touch the base cost of the newly acquired depreciating asset. Instead, that gain is held over, it is deferred until the earlier of 3 events. Now, I'm hoping that you might remember them, but again, as with any memory exercise here, the only time you need to know it is on the day of the exam. So if you don't know it now, make sure you do by that particular date. So let's have a look at what we've got here. And again, all of this, as I say, should be very easy for us. At least I hope so. A gain may be rolled over, i.e. deferred, where it arises on the disposal of a qualifying business asset whose sale proceeds are then reinvested in another qualifying business asset. So what are these qualifying business assets? Both the old and the new assets must fall into one of the following categories: land and buildings, fixed plant and machinery, though as we should know and we'll see in the note on depreciating assets, that one is always going to be classified as a depreciating asset. Therefore, we won't be able to roll over, but we will be able to defer that gain, to hold that gain over, because of the reinvestment being in a depreciating asset. A depreciating asset, remember, one with a life of not more than 60 years, or otherwise fixed plant and machinery. It effectively means that for your syllabus, there's only two assets that classify as depreciating assets. That one, fixed plant and machinery, and one type of property of land and buildings. And that is where we're talking about leasehold property of not more than 60 years. If we've got a 55-year lease acquired, a 45-year lease, a leasehold property, anything that isn't more than 60 years there, then that is going to be a depreciating asset, and that changes the nature of the deferral. We don't roll the gain over against the base cost of the depreciating asset. Instead, it's deferred until the earlier, or yet again, of those three events. We'll remind you of those soon. Both the old and the new assets must be used in the business. The relief, the gain is not taxed immediately. No, it's a deferral. It's postponed until the company makes a disposal of the replacement asset without any further replacement. If, as we normally are, dealing with a property used within the trade, if we sell and buy and fully reinvest, sell and buy again, fully reinvest, then those gains can continue to be deferred. If we reinvest and we reinvest all of the proceeds, time after time, now 10 years' time, 20 years' time, whenever the subsequent disposal takes place, if we're selling a qualifying business asset, we're reinvesting all of those sale proceeds in another qualifying business asset, then we can continue to defer, we can continue to claim rollover relief. Where we can't claim full rollover relief is where, yes, we reinvest, but as we said earlier, we don't reinvest all the proceeds within that 4-year period open to us. The postponement is achieved by deducting the gain made on the old asset from the cost of the new one. The reduced cost gives rise to a bigger gain in the future. That historically wasn't just that the fact the cost was lower by the extent of the deferred gain, leading of course to an equivalently bigger gain when that lower cost is deducted from the sales proceeds of that asset in the future. But if you had a lower cost, then of course indexation allowance would also be lower because the indexation factor applied to that lower cost. All of that, of course, is irrelevant post-December 17 when there is no indexation allowance, so it's not going to impact for the future. But there could be still stuff coming in that is an echo from the past there where there is indexation because the asset now being sold was, of course, bought before December 17, and therefore there is an issue. Where the disposal proceeds of the old asset are not fully reinvested, as we've said, the surplus retained reduces the amount of capital gain that can be rolled over. To the extent that you fail to reinvest all the proceeds, the bit of the proceeds you've taken out on that deal, that is the amount of the gain that will continue to be chargeable. And only the balance, if there is one, can then be deferred through rollover. We've said about the 4-year window of opportunity available. Got to be bought in the period 12 months before to 36 months after the disposal of the old asset. So it doesn't have to be all at once. The reinvestment can be up to 12 months before the sale has occurred there, which might sound odd, as we said before back in chapter 14, but it's probably the most common situation. You probably do buy a replacement property just before you sell the old property there. So it's not as daft a rule as you might think. But you, again, will look at the date of disposal, you go back a year, go forward 3 years, in that 4-year period have we made the reinvestment required. A claim must, of course, again with these reliefs, most of the ones that we see anyway, a claim has to be made, it doesn't automatically apply, but a claim must be made within 4 years from the end of the accounting period in which the disposal occurred. Again, remember, we're dealing with corporate tax now, therefore we're dealing with accounting periods, we're not dealing with tax years anymore, as we did for income tax when dealing with the unincorporated trader. We then got a couple of examples. Let's see if we can see what the difference is between the two. Example 1, calculate the chargeable gain and the base cost of the new asset. JM Limited had bought a building for use in the business back in October 94. There was your cost 150. The building was sold in March 2022 for £400,000. There's our proceeds. Given that it was also, of course, acquired well before December 2017, there will be indexation. We have here a given indexation factor of 0.929 that was from October 94 through to December 17, as far as we can go. In June 2021, the company bought some land for use in the business for £500,000 there. So, first of all, there's a simple capital gains calculation for you to perform. We have sold this building for £400,000. It was bought for £150,000, and we have an indexation factor to apply to our allowable cost as 0.929. That will compute the chargeable gain. Then the issue of rollover. The assets in question, land used within the business, within the trade there, and that therefore represents a qualifying business asset. So rollover will be possible if the reinvestment has occurred within the relevant time scale. When was the disposal? Sold in March 2022. When was the acquisition? June 2021. Before the disposal date. Is it within the 12 months prior to the disposal date? Yes, it is, and therefore rollover is possible. The next question is, well, it's possible, but will we have all of the gain being deferred? Have we reinvested all of the proceeds? Well, we sold for £400,000, we bought for £500,000. Yes, we have reinvested all of those proceeds. So compute the gain in the normal way, then all of that gain may be deferred with a rollover relief claim. What does it do? Well, now it defers the gain. It will not therefore be included in the corporate tax computation for the accounting period in which the disposal occurred. Full rollover relief, as we've seen, is available here. That therefore means that the base cost of the newly acquired property, this land used in the business that had cost £500,000, that'll be reduced by the extent of the rollover relief, meaning that with its lower cost for the future, then a bigger gain will arise. In example 2, we're again computing the chargeable gain and the base cost of the new asset. We're told A Limited originally bought land for use within the business in May 2003 for £200,000. Sold in March 2021 for £350,000. Yes, a gain will arise, a gain of course that will then be subject to indexation allowance, and there's the indexation factor from May 03 to December 17. We know what the cost is, we know what the indexation factor is. Again, it should be very, very quick and easy calculation of that gain. The issue then is about the extent, if any, of rollover relief available. In September 2022 there, the company bought a factory for use in the business for £335,000. Date September 22. Sale March 2021. This reinvestment is occurring after the disposal. Is it within the relevant timescale? Yes, of course it is. This is well within the 3 years following the disposal date that this reinvestment has occurred. The issue, of course, is that it's now only partial rollover. We have reinvested 335, having sold for 350. What does that mean? Of the chargeable gain you compute, 15,000 will remain chargeable, at least at that point in time. Remember that rollover relief doesn't require simply we sell one asset and we buy a single replacement asset. Yes, an asset, a single asset, will have been sold. It gives rise to a chargeable gain. But the reinvestment that goes towards any rollover relief claim or claims, the reinvestment doesn't have to occur all in one. Here, we're told about one such reinvestment, that having sold in March 21, that would mean that we're talking about 3 years on from that, so that would be March 24. As long as a reinvestment occurs within that time scale, then rollover relief is available. We're told about one such reinvestment in September 2022 for 335. At that point, we have failed to reinvest 15,000 of the proceeds. So, as we've said, 15,000 of the gain that has arisen remains chargeable. Only the balance can be deferred with a rollover relief claim. At least at that point, re what happened in September 2022. But we've got up to March 24. So if A Limited here, it did buy further qualifying business assets before March 24, if that purchase reinvested the remaining, well, 335 to 350, the remaining £15,000, then a separate and later claim for rollover to come back to the accounting period in which the gain arose could be made, and that gain could once more be deferred. The effect of that rollover relief claim, if it is, as it may well be, a long time after when the original gain arose, by that date we may already have paid the corporate tax that included that chargeable gain. Well, it's not a problem. We just go back to the accounting period in which the gain arose, how much of that, maybe all of it, can then be deferred, and that means that the profits for that period are reduced by that amount. Those profits presumably would have and have already been taxed at 19%. That was the only corporate tax rate that we need to be aware of. Then that tax has already been paid, but we've now removed that gain from chargeability. So what will we get? A repayment. When you put the claim in, yeah, we eliminate that gain. You've already paid the tax on that amount of gain. Therefore, we'll now repay that amount to you. So the company will get its money back through that later claim for rollover relief. If, of course, you're dealing with a situation where by the time you come to pay the tax for the accounting period in which the disposal took place, if by that point in time you have already made the reinvestment, then you'd be in a position to immediately claim rollover relief and you'd never have to pay the increased tax figure in the first place. That amount of gain would be deferred, would go into the corporate tax computation and into our corporate tax return when we submit it to HMRC, which would show the reduced gain, and we pay the tax on the lower amount of profit. So there we've got our typical examples of full reinvestment, partial reinvestment. Over to you, therefore, to finish those two examples off, deal with those numbers, get your answers, please, and I'll see you again at the answers to this once you've attempted your goes at this, of course. Okay, again, let's see how we've got on with this one. We know the proceeds, we know the cost, we know the unindexed gain. We're given the indexation factor, we know the allowable cost, calculators out, get your indexation allowance, and we have our figure of chargeable gain. Prior that is to any claim for rollover relief taking place. In this first example, we had noted that the proceeds of the sale are fully reinvested into a qualifying asset within the specified time period, which here of course, was the relevant the period before disposal up to 12 months prior to the disposal date. So the entire gain of 110,650 can be deferred until the sale of that land. So what has actually cost you 500,000 is reduced by the extent of the rollover relief claim. That was the full gain that arose, bringing you down to a base cost. So when the company sells that land in the future, you'll be using a base cost not of 500,000, but the reduced figure of 389,350 there. Again, if at that point we sell, we buy, we fully reinvest, then that process of deferral can continue on and on. In example 2, always I guess the more likely scenario for an exam question, and that is that you're having partial rollover rather than full rollover. So at least at that point in time when the partial reinvestment has occurred, it still leaves you with some amount of the gain remaining chargeable. Do your gains calculation to begin with, of course. Again, very straightforward. As ever, proceeds, cost, unindexed gain. Take away your indexation allowance and get your chargeable gain. Now this time we have failed to reinvest all of the proceeds. Sold for 350, bought for 335. We've taken out £15,000 cash on the deal. Therefore that £15,000 will remain chargeable, and it's only the remaining gain. Well, 41,400 minus 15 is 26,400. You can see the calculation done there. Can be deferred as That's indeed as partial reinvestment, there we go, has occurred within 3 years of the disposal date. If you were dealing with this issue within a Section C written question, so we got a corporate tax computation to prepare, there's been a disposal, there's been an acquisition, it is partial rollover, you do the calculations as we have done here, so we know how much gain will remain chargeable. We would be noting, therefore, what happens as regards the rollover. We'd have shown those computations, how the rollover relief had been deduced there. But you could also at that point make a narrative comment, as this is a written answer that you are doing. And that written answer would say that a further claim for rollover relief may be available in respect of the remaining gain chargeable at this point of £15,000 if a further reinvestment in another qualifying business asset occurs before the deadline being 3 years from that disposal date. If we're still within that 3-year period from the disposal date, there's still the possibility of a further claim for rollover relief occurring. Show your higher skills. It's certainly what you'd have to do if you were doing advanced taxation. And if you get it, and only if you get it in a written question, Section C question, would I be adding in that note there to explain to the examiner, yeah, I know what is happening at that point in time, but effectively my job when dealing with my client is to tell them, yeah, at this point we can do this for you. This amount of the gain can be deferred, but 15,000 will remain chargeable. We'll include that in the corporate tax computation. But look, there was your disposal date. 3 years on from this is this future date. We've not got there yet. And if before that date you are thinking about making a further purchase in what would represent a qualifying business asset, then doing it just before that 3-year period is up rather than just after makes very good sense, because we could then come back to the period for which this corporate tax comp has been prepared and remove that remaining £15,000 worth of gain and get a repayment of the corporation tax that by then we had already paid. Again, good planning skills being exhibited. Okay, in terms of the base cost of this newly acquired asset, it was 335, but we've got £26,400 of the gain capable of being deferred, reducing that base cost for purposes of a future disposal down to 308,600. Again, calculator permitting there. Check that out, please. Finally, issue then when dealing with depreciating assets. Here we must know first of all what a depreciating asset is, and that's what we said at the beginning of this particular session on rollover. What we said was, in terms of a depreciating asset, it's going to be one of two things in your exam: fixed plant and machinery, just those words without any reference to life. Fixed plant and machinery will be here a depreciating asset. If we are also talking about, as the definition of depreciating is one with a life of no more than 60 years, if we are talking about a leasehold property that is a lease that we've acquired of less than 60 years, then these are depreciating assets. So we still calculate the gain on the qualifying business asset that has been sold, but we then recognise that what has been bought within the same time period, year before to 3 years after disposal date, that what has been bought is a depreciating asset. So at this point in time, the impact is the same. Reinvest all the proceeds, full deferral. I won't say rollover, full deferral. Reinvest some, but not all of the proceeds, then the best we can have is partial deferral. And some amount of the gain will remain chargeable, at least at this point in time. And we have to then explain that the deferral does not roll over the gain against the base cost of the newly acquired depreciating asset. Instead, the gain is deferred, awaiting the earlier of three events. Those three events here are, as you see written there in note 2.2. Postponed until. What do you think would crystallise the deferred gain? Well, hopefully, obviously, there, the disposal of that new asset, that depreciating asset. We sell the depreciating asset. Or the date the new asset ceases to be used in the trade. We only get the deferral here, we only get the relief because this is an asset that is a qualifying business asset, which means it's used in the trade. But no matter what else happens there, that if we get to 10 years after the new asset was acquired, and we still own it, and we're still using it in the trade, that's it. That's as far as the deferral will stretch. 10 years after the new asset was acquired. That's when your 10 years runs from the acquisition date of this depreciating asset. It doesn't run 10 years from the disposal date, it's 10 years from the acquisition date of the depreciating asset. So, we've got an example here, therefore, example 3. The company bought land for use within the business in April 97 for £200,000. The land was sold for £350,000 in May 2014. So this is a long way back. You expected, no doubt, to see that sale happening now. But that land was sold for £350,000 in May 2014, at which point a gain would have been computed. In March 15, YR Limited bought fixed plant for use in the business, costing £390,000. The question may also say, at which point any available claim for relief was made. What that means here is that when we bought within the, well, it wasn't the 12 months before, but it was 3 years after the date of disposal of a qualifying business asset, the land used within the business. When we bought fixed plant for use within the business, then this was a depreciating asset. It will still allow deferral under the usual means. Did we or didn't we reinvest all of the proceeds? The land was sold for £350,000 and we bought the new land, sorry, the fixed plant I should say, for £390,000. We've reinvested all of the proceeds. So at that point, a claim was made to defer all of the gain that arose on the disposal of the land. A simple enough gains calculation for you to perform. Again, you'd be able to do that. You have the relevant indexation factors down there. You simply have to pick the right one. What then happens is YR Limited sold the plant in February 2022, at which point we're now told that YR Limited has a 31st of March year end. Hence the requirement, calculate the chargeable gains as far as the above information allows for the year ended March 15 and the year ended March 22. Now, we can see that, again, we had the sale, the original sale of the land was back in May 2014. That would have been in the year ended March 15. We've got this sale in February 22. That's in the year ended 31st of March 2022 there. So in those accounting periods, what's going to happen? Well, given that back in 2014-2015, when the sale and the purchase took place, all of the proceeds from the sale were reinvested in the depreciating asset. All of the gain that arose, you will have to compute that gain, of course. You've got the relevant information there. Bought for 200, sold for 350. Pick up your indexation factor, apply it to the allowable cost figure, get your gain. Full deferral because we sold and we reinvested all of those proceeds. But what then is going to happen? In terms of year ended March 22, there is the sale in February 2022, so within that accounting period, without information about any other reinvestment having taken place. Therefore, that sale of the depreciating asset would cause the gain to crystallise. We can assume here it was still being used, this plant and machinery, sorry, the fixed plant and machinery. We may assume that that fixed plant and machinery was still being used within the trade. So the fact that it was still being used means we hadn't ceased the business use, and therefore that has not caused the gain to crystallise. Also, we are within 10 years of the acquisition date. The acquisition date was March 15. So if this sale hadn't occurred, come March 2025, so the year ended the 31st of March 25 there, if this sale had not occurred of the fixed plant and machinery, that is as long as the gain could be deferred. It would have crystallised in March 2025. So in that accounting period's corporate tax computation, bang, that deferred chargeable gain would then crystallise. But because of the sale of the fixed plant in February 22, we're not going to have to wait around until the year ended March 25. In this, the year ended 31st of March 22, the deferred gain will crystallise. So, again, over to you, therefore, to have a go at that example and explain what is happening in those two accounting periods, putting the numbers in. We need to see the numbers there, please. I'll join you again when you've done that, and we'll have a look at the answers together. Well, given the discussion we had before I let you loose on this, hopefully no problems now looking at this brief answer. Work out the gain as we always do with the proceeds less cost, less indexation allowance, and we get our chargeable gain as per usual. What we detect is that the gain is able to be deferred due to the purchase of the fixed plant within 3 years of the disposal date, and will be chargeable in the year ended March 22, the accounting period in which that disposal occurred, as we say, when the depreciating asset is itself sold. Or, of course, ceases to be used in the trade, that would also be true. That occurred in February 22. As we said, that's earlier than 10 years from the date of acquisition. That was back in March 15, so to March 25. And as we said, if we hadn't sold this period and we still had it at the end of the year ended 31st of March 2025, that would be it. The gain would crystallise in that accounting period. That would feature on the corporate tax computation, and we'd then have to pay the tax on that gain. Just one final point, can't really see it being an issue other than in a written problem, and even then it's incredibly unlikely. But just, it's there, so again, it's within our syllabus, so just to be aware of it. We've seen what happens when the replacement asset is a depreciating asset. The gain is deferred, as we've just seen. However, if a non-depreciating asset is purchased before the deferred gain crystallises, so that's got to be within 10 years of the acquisition date there, because that's the latest point at which the deferred gain would crystallise. But if a non-depreciating asset is purchased before the deferred gain crystallises, the original gain may then be rolled over against the cost of the new non-depreciating asset. That will only crystallise on the sale of the non-depreciating asset. Put, I hope, in simple terms, if you had, for example, a freehold property, you had a freehold property used within the trade, and then it was sold, and you moved into a leasehold property, but that leasehold property was, say, a 55-year lease. Anything that isn't more than 60 years. If all the sales proceeds had been reinvested in the cost of that leasehold property, then all of the gains would have been deferred, but we wouldn't have rolled them over against the cost of that leasehold property, wouldn't have reduced that cost, we'd have simply deferred it, awaiting the earlier of those three events. Well, if what then happened is before we got to the 10-year anniversary, we were to replace that leasehold property with another freehold property. So we went back into a freehold property. If it's freehold, then it's not a depreciating asset. It's just a normal qualifying business asset. Then what had been purely deferred through a sort of holdover situation when we bought and when we continued to own the leasehold property in that period, if we then sell and we then sell, the sales proceeds come in and we reinvest in the cost of the freehold, then what had only been held over, awaiting crystallisation at the latest point, 10 years after the leasehold property had been acquired, 10 years after that replacement property had been acquired. If before that date, before the crystallisation, we reinvest in another non-depreciating asset, i.e. a freehold property, then what had only temporarily been deferred against the non-depreciating asset, that, assuming full reinvestment again takes place, could now be the object of a claim for rollover, where we would deduct it from that cost to give us a revised cost, and then that means that that gain would only come back to haunt us in the future whenever that final or that freehold property there was to be sold. And even then, if it was sold and replaced with another freehold property, you could continue the deferral process. So what was held over to begin with, because the initial reinvestment, I should say, was in a depreciating asset, if before that gain crystallises, you reinvest again in a new non-depreciating asset, what had only been held over could then be rolled over. Well, that brings to an end our studies of capital gains so far as corporate tax is concerned. So now, in any question you see, whether it's section A, B or C, whether it's objective testing question in sections A or B, or whether it's a written response question, constructed response question in section C, whether we're dealing with an individual or a company, always the first thing to look at in terms of exam question, who is doing the selling here, knowing whether it's CGT or whether it's corporate tax in terms of capital gains, we should be able to deal with any of the possible situations that we might now see. Clearly, some are more difficult than others. That's the way of the world in terms of exams. There are certain questions or certain parts of certain questions that are more difficult or more easy, and it's down to you individually as well as to what you find personally easier or more difficult. That happens, that's the way of the world. But you should now have covered all of the knowledge that you need to know and be able to apply in this exam. What you'll, of course, need to do is to check out those technical articles, of course, that the examining team so graciously produce for us, not just reading them, but working the many, many examples that are contained within them. Use it not just as a sit there and read it exercise. So there's the example. What's the answer? Oh, that's fine. Yeah. You work those examples for yourself. That's the essential practice. It's easy to audit an answer. Just make sure you can prepare that answer for yourself and you don't just sit and audit it there. In our next chapter, we'll be returning to corporate tax. Well, we never really left it. We just focused for the last 3 chapters on capital gains for companies. It was still corporate tax. But it's full-blown corporate tax in the next chapter and the last issue that we need to deal with for corporate tax. In our introductory chapters, what we have been dealing with is a single company. What we deal with in the next chapter is a group of companies. And where we have a group of companies, so a parent company and subsidiary companies, depending on the exact percentage shareholding held by a parent company in a subsidiary or even in a sub-subsidiary, then dependent on what those different relationships are, there are different issues that we need to deal with. Some of this is good news, reliefs that are available within a group. We mentioned it when looking at Chapter 18, Corporate Tax Losses. But if we're in the right type of group, then a loss made in one group member can't just be used within that company that was the loss maker. We could move any part of the loss out of that loss-making company and choose to share that loss with another group member within the relevantly sized group. That's all based on, as you'll discover in the next chapter, the percentage shareholdings held by the parent company in the subsidiary. Because although in real life, probably most subsidiaries are wholly owned, in exam questions, they're certainly not. They're sometimes more interesting, shall we say, than that. So there are some group issues where this is good news. We're able to get a more friendly tax treatment as a result of the legislation that has been enacted. There are, of course, then other rules that limit what we are able to do and may create chargeability where maybe we had hoped there wouldn't be. Now, what those rules are, what those reliefs are, what claims can be made, all of that awaits us in a much more interesting chapter, some may say, when we deal with groups of companies.